Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Avoiding Traps in Real Estate Syndication with John Matthew and Doug Phillips of Republic Investment Group. As a quick note, please be aware that John and Doug will be answering questions at the end of the presentation. However, feel free to use the Q&A function and chat on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your personal funds or retirement funds. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll switch the slides over to the presentation and we can get underway. All right, John and Doug, it's your show. And you're both muted at the moment as well. So you guys can unmute yourself when you guys are ready.
Thank you all.
Hey guys, it's Doug Phillips here, Republic Investment Group. I'm here with John Matthew. And we are going to sort through some information for you today. Hopefully it's useful. Hopefully it's maybe a little bit entertaining. The title of the program, as you can see here, is Avoiding Traps in Real Estate Funds or Syndications. And we know that a lot of us have all heard about syndications and funds and that sort of thing, but a lot of people just invest in them without necessarily knowing what to look for, what things to consider, maybe which funds to look at, that sort of thing. So we're here to try and help sort through the questions, the answers you should be asking, the questions you should be asking, the answers you should be seeking, and some things to consider, for modern fund investors. All right, things we're going to talk about today are, why you need to understand this fund stuff. It's not just as easy as just throwing your money someplace and trusting another group to take care of it. Some people do that. Sometimes it works out, sometimes it doesn't. But we're going to cover more in detail about these things, which is clearly part of the title. This is relevant today more than ever. We're seeing the interest rate changes causing things to happen in the market, the big changes in the real estate, the commercial real estate industry, and how those things are changing and shifting rapidly, which is directly affecting banks and their viability. Every bit of this can affect you as an investor when you're talking about real estate and in funds, and we'll get into why that's important. And then obviously we're going to talk about when you have an investor, when you're working with investors and funds, we're going to set you up with some questions that you need to think about, and questions you can, maybe a template of sorts that you can come together with and help yourself invest effectively. And then at the end, of course, we're going to try and help you understand that you can always reach out to us if you need further information about this. All right, then I'd like to go ahead and introduce John Matthew. He's the top dog here at Republic Investment Group, and he comes with lots of information. So John, take it over.
All right, thanks guys. So hopefully you guys can hear me okay. Hey, so I'm John Matthew. I am the CEO of Republic Investment Group. Just a little bit about myself and just a little history on what I do. I actually we're in the Dallas-Fort Worth area, and I've been in Dallas since like 1985. I went to Texas A&M and graduated with a EE. And I graduated after that with the MBA in SMU, from SMU. Along the way, I worked at companies like Texas Instruments, Raytheon, and a couple of other ones. And, my real estate journey essentially started in 2004 when I purchased my first property. The first property was actually a 5-bedroom home. And at that time I was a bachelor. So basically what I did is I said, I'm going to rent out it was a 5-bedroom. So I was going to rent out the other 4 rooms and I made income from it. So my real estate model really started in 2004 with, doing a house hacking model, right? And we moved forward. And I purchased some other properties along the way, and I was trying to understand. I was never involved in it. I've always done stocks, option trading, other types of investments. So real estate really got into in 2004, and it really elevated in 2008. So in 2008, as everybody knows, the market basically crashed, and everybody is trying to determine how to do their, try to figure out how to do the next step. What happened to us is that when the economy crashed, along with it, my dad actually retired from his profession, and he took out his retirement fund and actually just went and bought a property. So now I was going to be more knee deep into it, more than I wanted at that particular time. So I got into the investments with him in 2008. He went and purchased a property. I went and got a real estate license at that time and started practicing real estate, knowing the comps, knowing how things work. So my job was to understand the market comps, make sure that we were making good investments as we moved through it. This cycle went on for the next 8 years, and we purchased quite a bit of properties. We were turning like 6 to 8 properties per year, working through it. In 2016, we started up this company, which is Republic Investment Group, and we started taking bigger projects. We've taken on larger developments, working through these projects because now we were using the syndication model. We were working with family and friends, other type of investors, JVs, working with partners on projects. We went through this process from 2016 onwards to now. And recently we just started a 506c fund. And so our intent today was basically, we come from an investor background, we come from development background. So we want to just give you some information that you can ask, you can think through it, and we want to try to help you understand what it takes to be an investor into a fund or a syndication. Thank you.
All right, thanks, Sean. So I'm Doug Phillips. I'm Vice President of Acquisitions and Business Development here. I have a 31 plus or minus year background in real estate. I started the industry in appraisal back in 1991. About 1995, I got involved in investing, flipping houses, and that sort of thing. And the investment, direct attachment on investments, over 400 properties. I think we kind of like to say we quit counting at that number. We did everything flipping wise back in the day, from, well, you name it, flipping. We tried our hand at mobile homes. We tried everything. Primarily sold our houses back then through owner finance, but we sold a lot of houses, kept a lot of inventory and that sort of thing. Since then, I've maintained my appraisal license throughout my life, my adult working life anyway. I continue to be a licensed real estate appraiser here in the state of Texas. I've also been involved with managing some funds for other people. I have done some consulting for Fannie Mae. I have spent a good bit of time lately, before my tenure here, I was involved in private lending, where I was more or less involved with a much larger number of investment properties and getting involved with the lending to those clients there as well. Born and raised here in Texas. I have a bachelor's of business in management and marketing, and that's where I started. Originally wanted to be an architect, and the dean of the engineering school told me not to, so I didn't. But I've loved real estate since I was a kid. Cut my teeth working on houses very young. My best friend's dad was a school teacher, and we painted and repaired houses for extra money in the summer, back in the 70s and early 80s. And then just kind of stayed with real estate ever since. So that is the rough and tumble of Doug in the real estate industry. And so we just put all this knowledge and work to make things better for everybody.
Thanks, Doug. What I like to do is I want to start getting to the topic now. When most people get into investment funds or a syndication, there are terms, there are things that people hear and not know. So just to baseline everybody, I just want to cover a couple of things, make sure that people understand what we're talking about, what the definitions are. So if we say something, make sure everybody understands exactly what we're talking to. So the first one is PPM. So for a fund, most likely there's always going to be a PPM that's affiliated with the fund. And the PPM is it basically does what the fund is supposed to do. It outlines, and it's like a flow chart of, we will buy this type of property. We will do, if you're doing crypto, this is the crypto area we're in. If you're doing any kind of specific investments, the PPM specifies that. So as we were saying, the word, which is a private placement memorandum, it basically is the Bible, right? So anytime you hear PPM, whenever you're looking at a fund, look at the PPM, understand what it is that it states that it's going to go do. So if it says we will buy single family homes, but then the fund ends up buying something else, then there's a disconnect, because the PPM said that's the only thing that they can go do. Some other terms you'll hear is like 506C. A 506C investment is an investment which is what we've set up to work through to do any kind of investments in our PPM. So it basically states the main difference in a 506C and a 506B, which is that 506C, which is what we have, works only with accredited investors. So accredited investor, the way I remember it, it's like 1, 2, 3. You had to have either $1 million in assets above your primary residence, or as a single person, you got to make $200,000 per year for the last 2 years, or 300,000 combined as a couple for the last few years. So the 1, 2, 3 is the way to remember the accredited investor role. So we work with accredited investors and we work with non-accredited investors. So the 506C basically says we work with accredited investors, and it allows us to do this thing called general solicitation, which means we can promote our securities, we can promote our features for it. So if you hear the word general solicitation, it means it's only for the 506C funds. 506B also allows it allows actually both accredited and non-accredited, but it doesn't allow the general solicitation, which is the biggest difference. And then each fund will also have a thing called the LPA, or a subscription agreement, which is basically allows them to say what are the agreements put in place between the limited partner and the general partner. Go to next. So we're basically focusing on the real estate fund side of things, right? So we want to show different types of investment funds, but we're just going to specify, and we're going to talk about exactly what a residential real estate fund would be. So all of our examples will be specific to the residential investments. But whenever somebody says real estate fund, it can be a commercial property, it can be a specialty property, it can be industrial, it can be a REIT. There's a different definitions of what happens out there of what a real estate investment is. So today, for our example and what we want to talk to, we'll focus more on the single family, multifamily residential property side of things. So every time you're looking at a fund, what we suggest is use this particular template to determine the validity of that fund, right? So ask a couple of questions, ask to figure out what it is that they're setting out for. So first one would be market risk. It sounds pretty simple, but when a fund is working through it, you want to ask, where are you investing? Why are you investing? What does the market look like? Doug, any examples of that?
Oh, yeah. I mean, you just have to consider so much, just like when you were let's say you were buying a house for yourself personally, you would think about what kind of schools are my kids going to go to, or, all the things that you think about when you're picking a property for yourself. These are the same things that we have to consider when considering areas or houses or properties specifically for investing. If are there upcoming things that are going to be happening to the market in that specific area potentially, that could cause us to think that maybe the values are going to go down. It's just important to have your as they say, have your ear to the ground here. There's just so many other, this is actually kind of a large, while some of these other, the list that follows, these are a little bit more specific. This is a fairly broad reaching category here, and it can take, can cover lots of different things. So, you know, covers things like rental income and,
Yes, what we'll do is that as we're going through this, what we did is, you know, we taken some of the questions and basically we applied this template to it. So you can see, hey, if it's this particular scenario or this particular question, how do we attach this template and work through it? So that's our intent, is that we can help you sort of see what to ask. So after market risk, it's going to be liquidity. So real estate in general, you know, it's one of the harder properties. It's considered illiquid, which means that it doesn't have an immediate return. You're not able to go and sell a property in, you know, 5 days and return or whatever. So Doug, any example?
Yeah, and this is important. Obviously, if you put your money in something, you need to understand how quickly you can get it out effectively. Obviously, there's probably going to be some situations where you might be able to get your money out faster than expected, but you're going to pay heavy penalties on that and that sort of thing. So liquidity is something that we consider, and you should too when you're investing, because of these reasons primarily.
The other one to look at it on a fund is a leverage risk. Our fund is 100% equity, which means that we do not leverage. Most funds do leverage on it. And what leverage means is, for instance, if you have like a $10 million property that the fund is going to purchase, it's probably going to raise about $2.5 to $3 million in equity, and then go leverage the remaining $7 million. And what happens during that leverage is that $7 million can go into a foreclosure or some type of risk. And so what we try to do is, you know, real estate, most people get into real estate knowing that they're secured by an asset, right?
Yeah, that's correct. I mean, this one pretty much speaks for itself. If you're invested in a property or an asset that's leveraged out, and something happens to the bank that you're leveraged with, or if something happens to the project, the bank is going to protect itself first. When you think of leverage, you need to think of, you're not in total control of the property. It's just like if you owned a farm someplace, you could do whatever you wanted with that farm. You could sell it or do whatever. If you're leveraged with a bank and a bank has a note on your property, you have to pay them off before you can do anything, meaning taking funds from a sale, that sort of thing. So it's just important to understand how your money is used and what your level of control is on the properties that you're invested in.
But again, the biggest risk that we see from leverage is the interest rate risk, the foreclosures, other opportunities of you not being in control of your fund. So obviously, I asked the questions of how the fund manages that appropriately. The next one is management risk. We ultimately believe, you know, the people who run the business of real estate should be real estate experts. So you will see a lot of fund managers that has, I don't know, Dr. Gupta or something, right? They're probably also in the real estate. They're also running a fund, right? So, which might be okay because they have the experience, but always ask the question from a management perspective: how do you acquire properties? How do you manage? How do you dispose? You know, those are the main levers that are put in place so that somebody understands what it takes to make it profitable.
Yeah, again, you know, understanding the knowledge base of the people that will be managing your money is very important. You wouldn't go to a doctor without understanding their qualifications. When you have someone managing your assets, you want to understand what their experience is and what their techniques are, and if that works for you to the best of their ability.
The other one is concentration risk. So most funds, you want to be wary of it, but obviously, if they're focusing on one zip code or one area too much, because all your investment at that point is concentrated in a specific area, right? So it's pretty self-explanatory. You know, you have to be careful that whenever you take on any fund, whichever fund you work with, you want to ask them, where is it that it's positioned? You know, what happens if something goes wrong in this area, this particular thing? You don't want to be heavily concentrated into one area. There's other things like regulatory risk. Sometimes there's laws in place. So for instance, if a fund says, hey, we're doing all Airbnb type funds, and once they do that, they purchased 40 assets, 50 assets in one location. Well, as soon as the rules or some kind of zoning changes where they cannot do Airbnb, what is the risk at that point, right? So you want to be aware of what the fund is stating that they will go work through and make sure that, you know, the laws are in place to support their model.
Yeah, another factor, important thing here would be things that are related to what we call opportunity zones and things like that. So if you understand these areas well, you can invest in particular markets that through the regulatory agencies and things like that, they can provide economic benefits and things like that for staying in, investing in and maintaining investments in particular areas. These things can be very beneficial through their platforms or through taxation, those sort of things, which ultimately means a better bottom line for us and the investors.
Yep. Next one is the interest rate risk. We highlight this because the world we live in today, right? So previously it used to be, in 2 years ago, interest rates were probably 2 to 3%. Today it's over 8%, depending on a lot of factors. But we want to know that funds, usually multifamily funds, take on a variable interest rate. So what happens is if they're locked in at 2% or 3% a while back, now you're at, you know, higher percentage. How will the fund manage that? And they may be able to do that. There isn't anything that says that they haven't prepared for it, but you as an investor should know what type of interest rate risk there is. And number two for us, number three, which is a leverage, is, you know, if the fund doesn't leverage, this factor doesn't come into play. So it's always, you have to understand where this will affect you.
Yeah, you know, we're not, our particular models, we don't leverage, we don't use leverage. That way we're not having to pay the bank along with factoring that into our, you know, returns and things like that. Obviously, if we're paying someone else before we're paying the fund, you just have to work double hard there.
Yep. And then the last one, the environmental risk, which a lot of people don't think about. But it is subject to like any kind of natural disaster. Nobody can predict a disaster. Nobody can predict climate change. Nobody can predict some of these things that will come down the pipeline. But what you can do is you can prepare. The way you prepare is when you go get an asset, you want to make sure that if, for instance, from an insurance perspective, is this property covered? Some flood insurance is not covered on a certain type of investment property. And if the fund doesn't take that, it goes to zero again if it's a major impact. So there are certain things you want to think about, even though you're not able to predict exactly what's going to happen tomorrow, 1 month from now, but you know certain areas, you know the data, and that the fund should be making decisions to say how they're preventing some of these exposures.
Sure. Simple example here I always think of when I'm talking about this subject matter is Florida. You know, Florida has historically been a very desirable real estate market. They've performed well over time. Everybody knows of it. Vacation, Wonderland, et cetera, obviously probably affected by hurricanes more than most other markets, if not all the other markets. So when you think about a giant storm ripping across the state and messing things up, this is what we're talking about.
So as we dive a little bit more deeper into this, there's certain questions that you should ask every fund, right? We've basically created a template that just says you can ask these questions to any investor, any type of funds. What we're trying to do now is we want to say specifically how did you know thread the needle a little bit better. Go deep dive into this. So some of the questions you should ask a fund is obviously what is their core investment strategy, and we'll dive into this a little bit more. But and other things like how is it different than other real estate funds? We're not the first real estate fund. Somebody else isn't exactly the same fund. So you should say what are the differentiators? What makes one particular fund stand out from others, right? How are the fund communication occurs? What are the modes of operation? How frequent is it? There's a lot of questions to be asked. Typically fund fees, a lot of people don't see, you know, what the fees are for the fund. They see a high return, they see a certain percentage, but do you know the details of where the fees are and expenditure? And then their projects, how do they choose some of these projects? What's the driving factor? What would motivate you as an investor, if you were to make these investments, do you align with these criteria? Most fund experts are what they are, experts, which is what they know the business, but they should be able to tell you the same thing, which is, hey, we invest into this strategy for these reasons. And we'll go into it a little bit further here. So number one question, right? So most people ask, what is the fund strategy? How do you make money? How do you do things to turn and burn, right? So number one question you should ask a fund is, how much debt are you taking on? So this is a question that's my favorite topic, just because I think it tells you how it works. So if you look at the SVB from a few weeks ago, do you really think a bank will crash? Do you think somebody is not going to? There are things that you think about that you're learning today that you never imagined that would be a possibility. So we want to look at what kind of what debt income ratio that they're taking on. So if a fund is again a $10 million example, how much debt are they taking to make that work? And what happens if it's a rental, specifically if it's a rental criteria, if they're not able to pay that amount back in a certain time? Number one risk is obviously the foreclosure risk. We want to mitigate those kind of risks. So understanding their debt structure is a critical part of the fund investment strategy. Again, the geographical locations, to look to see where the fund manages things. Is it all in one zip code? Is it in different areas? Because if the fund is heavily concentrated on one area for their investment strategies, again, there comes another risk. But some investors might be good with that. They may say, yep, I really want to concentrate in this area because I know it so well, or the fund has done due diligence to determine that certain areas work better than others. So there's always the fund knowledge of what makes sense, and then the individual knowledge. But always ask the question, does this make sense? Does this particular area make sense of what's happening? The other type is definitely in a fund you had to determine is what kind of, in real estate specifically, are you concentrating on single family assets or multifamily assets? It's two different beasts of its own. It has different returns. It has different models. So if you as an individual want to see a certain return between the two, you have to know how the fund is being structured. So if it doesn't align with your model of how you would invest, and somebody says, oh, well, this is how we work, you have to determine if that's a good fit for you. But those are questions to ask for it. What are the minimum and maximum? The reason you would want to ask this question is because you as an investor make your return at the end of the fund, right? So if it's a 5-year fund and the minimum is $50,000 assets, so the fund went and purchased assets that are 50, 50, 50, 65, 70, so forth, or maximum value, they say, hey, I bought $1.5 million properties. These are real estate assets we bought. These are in chunks of 1.5, 2 billion, and so forth. And then you have to sort of think through at the exit, is a $2.5 million property easier to exit, or the $50,000 easier to exit? Where is the marketplace? Again, the fund thinks through all those things, but you should ask just so that somebody is not over leverage in one position or another, because when the fund closes and you're sitting on, I don't know, 40 properties, 40, 50 properties at $2 million each, which made sense through the 5-year projection. But can you remember we said real estate is illiquid, which means if you can't exit out at that point, you're not doing the right mode. So you have to think about your exit strategies on how you're purchasing and what you're acquiring through it. Definitely look at the features of the property. So they may disclose, as a fund, we will not buy properties with pool, or we will not do certain things. And you might want to understand from them what it is that they're doing and why, because again, you want to look at exiting exiting that whole asset at the end of the 5th year or 10th year, or however it's set up. And you want to make sure that that property has features which will make it marketable to the property. We don't want to sit on some kind of asset where you're holding the property because there is no market for it and it's a very niche market. On developments, we look to see, again, every time we do any kind of development, what is our exit plan? Because we can't take on a property and say, okay, every asset here is about $400,000 to $500,000. At that point, will there be a market? Can we lease it if we can't sell it? So we need to look at other opportunities to make sure that we don't look at one type of exit plan. Can we owner finance on it? Can we do certain things? Is there a marketplace for it? Because every investment and assets you take on, you want to determine where the exit plan is so that you exit out correctly. And then again, from an investment fund strategy, you always ask the questions, who's on your team? You know, have you worked this side? What are the plans for certain strategies? Because there's, you know, teams that you'll see, funds are out there today. You want to see who's actually buying the properties. Do you have a good underwriting process? How do you determine what a value on this property is? And you can ask most typical fund managers, and they should be able to say, hey, this is our process. And you know, it's a good way to determine how they're going to use that strategy. Then here's the other factor when you're looking at funds, right? Every real estate fund, what is the biggest difference? Sometimes people say, hey, we're going to give you 35% IRR. And, you know, you're like, wow, that sounds great. But how did you make that IRR? How do you determine that it is this high percentage? You have to dig into the number. What I will look for is, instead of people saying IRR, make sure you ask them, what is the net IRR, which means after all the expenses, after all the fees. And I'll give you a little bit more examples as we go through this, but we want to make sure that just because somebody disclosed the IRR, which is your internal rate of return, that it may not be the number that they're broadcasting, because they have expenses, there's all overhead, there's certain fund costs that have to be paid. You can determine, and again, as you're diving through it, you can ask them, you know, your administration costs, what is it? What are the fees here? Because you are, at the end of the day, the fund manages to get you a percentage return, and you need to know how the net is for you specifically. A lot of funds talk about historical performance. They'll say, you know, we've been performing this for the last 2 years, but me personally, I look at real estate for the last 2-3 years, and we've been at a peak. So I wouldn't use that data, just because market's been great. It's not a typical. So we look at, like, you know, 10-year data. We look to see how things have performed specifically over time, because we don't want to say something is what, maybe there was an outlier. There was some properties in certain areas that increased in value, and all of a sudden this is our historical performance. We want to say that's great, but let's look at it further. Let's look at the bigger picture. So we always want to try to see what is out there and how it can be duplicated. So some funds are showing some of these historical information I would trust, but verify. The other thing is, again, the management team. We talk about it. Every real estate asset that we purchase has to go through an acquisition process. We have to have realtors on space. We have to have appraisers, title company, insurance, attorneys, CPAs. Every little profession has to be embedded into the organization to make sure, from acquisition to disposition, that it works correctly. If it doesn't, you're not the expertise at what you're doing. If you're purchasing assets and you're saying that this asset would be a great investment in the future, it's all forward-looking statements. It doesn't have a good plan to say how they're going from A to Z. Doug, you want to add anything on that?
I just always like to say that if you don't know what you're doing and you're calling yourself an investor, effectively you're just a buyer. Being smart about where you're putting the money, how you put the money, all that's really the key to the difference between being an investor and just being a buyer. And for the last many years, we've seen a lot of just buyers that think of themselves as investors. And I've always just thought that, in order to really be an investor, you have to do things a certain way. And that's not what a lot of people are doing. Obviously, it's very important here that you understand the little details.
Yep. A couple of the other questions to ask the different real estate funds is, do they diversify? How are they? Are they all in a single family space? Are they all in a multifamily space? Do they work certain strategies out that diversifies their portfolio out? So again, things to look at to understand how their modeling is. Fees and expense. Again, I would refer you back to the PPM, because every fund has their fees and expenses highlighted of how it would be, what they're participating in to be. Preferential rate, well, by the way, for fees and expense, we'll get into a little bit detail also here. For preferential rate, hopefully everyone knows what that means, but basically If preferential rate means that if a fund says their preferential rate is 8%, what it means is the fund has to perform to that level. So if they made 10%, the return to the investor would be 8%, and then the remaining 2% is on a carry basis and so forth. But it guarantees the 8% to the fund. So that's something that we'll make sure that you look at it. From a fees and expense and preferential rate, I'll try to put some numbers in it to see if it makes sense. For instance, a fund is $1 million. And for that $1 million fund, in 5 years, this $1 million became $2 million. So it's what we call a 2x multiple. So every year, the guys that are doing the math quickly, they're saying, oh, wow, you made 20% per year. You're making, we're all doing extremely well. Well, not there yet. Once you're there, now we look at the preferential rate. Well, the preferential rate says that you're doing 8%. So really on that $1 million initial investment that you're taking on, you're paying 8%, which is $80,000 per year times 5 years. So now you're at $400,000 that in preferential rate that the fund will pay out. So now after the preferential rate is paid out, what is the other fees? The other fees are like management fees. Sometimes management fees are 2%, but then you have the other expenses and fees. So if you look at a fund, you want to understand the full picture. So for instance, just to make numbers simple, if it's 5% total with fund administration costs, property management, all the other fees that's included, at 5%, it's $50,000 per year, and for 5 years, $250,000. So now 400 minus plus the 250, you're already at 650 in terms of fees and things before profit is even hit. So when a lot of fund managers talk about, hey, we went from 1 to 2 million, that's a big picture, right? That's great. But be able to dive into it a little bit more further and say, what is the net? Can you still make the 8% preferential rate? How do you manage all these things correctly? So as talking to different real estate funds, those are the things to go look for.
All right, this here is just a template. Basically, we talked about earlier, laying out a template of things to, like a checklist, if you will. What you're going to see is a lot of similarity to a previous slide where we went into detail about all these things: market risk, liquidity risk, leverage risk. These are all things that we discussed in detail earlier. But these are the reason we've done that, and you're seeing a repetition here, is simply because these are the important things to consider. Things you need on a checklist, you need to go through and answer to your own satisfaction these items to make you feel comfortable with who you're working with as far as investing.
Yep. So how are the fund performance communicated? A lot of funds, use different modes to communicate. They use certain standardization, but if it's a rental, if they have rental properties versus if they have flips, if they have developments, it's a certain mode to make a communication on. So what we look for is, if it's a fund manager, and it's a rental property, we look for rent rolls. We look at lease agreements. We look at property valuations. There's things out there that we want to be able to go look at and say, how are they performing? And is that information communicated? How frequent is that communicated? Some of the other key terms to look at it is net asset value. Net asset value means for instance, if you put in $10,000 as share value, what is that net asset value in a year, in 2 years? Did that 10,000 go to 15,000, 12,000? So that's the net asset value. There's the assets under management, which is the total assets. So everything that's purchased, that's called the AUM. We look at key performance indicators to determine when they're communicating these fund performances. How is it? Do they show certain of the fields that shows where income is coming in? Again, I would look at financial statements and disclosures to see where's the income, where's the cash flow, simple things that I think everybody looks to, but we want to just make sure that you're asking the questions that, hey, how often are you giving this information? Is it presented in a quarterly pattern? And if there's quarterly returns, where does it show? How do you get to see it? Always ask those typical type of questions. Most funds distribute quarterly and annually. They distribute a K1. But again, it is some of those things that you have to know to ask for and know ahead of time. Again, most companies are moving technology-based. They may not be printing out information or mailing, so you will have to ask them, do you send paper copies of this information? Do you have this? Or if they're on the very high end of technology side of things, you would want to ask them, can I look at my live data today? How is my fund performing? How is my assets performing today? Do I have a live view? So like our company obviously has it, but you would want to ask other funds, can they see that data live? And again, on an app or a portal, or how often the email is sent, you would want to just make sure that's being asked up front. And then obviously the distribution and lockup period. There again, at all times, I'll just say it's very clearly stated on the PPM. So obviously refer that. But along with it, the questions you can ask if they haven't answered is, how often is the distribution? Is it monthly, quarterly, annually? You want to look at the source of income. Are they making rental properties? Is it Airbnb? Is it capital gains? Is it lending? So you look to see how the fund is distributing based on their source. You also want to look at the cycles. So interest rate, how does interest rate and the business work as it is today in the real estate market? You want to see, is it stable, and is the distribution stable and predictable? So once you've been with the fund for a while, you have historical data with them, and they've produced every quarter a certain return, and they've showed you. But you want to ask the question: Is this accurate? Is this based on the tenants today? I've seen certain fund managers give projections. They buy properties at a certain area. They say this is rental rate is like we look it up, it's about $1.20 a square feet, but they say it's $3 a square feet or $2.50. And when we do our analysis, we say, nope, that's not possible. That won't even get there. That's all forward-looking statements. So you want to see how predictable they are. So if they're buying rental assets, they say based on a number of square footage, this is what we return. So that's how they're able to manage that distribution. The size of the property, what the income is and how it will be distributed. So all that information should be there. And you also want to know the tax implications. So when distribution happens, again, this is something you have to refer to your CPA. It wouldn't, regardless of what this fund says and based on your current income status, how distribution works. You have to be able to go look at it and say, what is beneficial for you? Do you need to see certain level of deductions? Are you going to have capital gains based on a certain distribution? So again, the CPA would have to give you that information, but it's something to look at it if you take distributions up front. All right, so the next one is, again, the fees of a fund. Everyone knows, and the example that I gave a while back, I was talking about the different fees. Again, most of the things will be set up in the PPM. But within there, for a real estate fund, you have to look at management, acquisition fees, disposition, asset management fees, any kind of incentive fees that are put in there, operating expenses, exit fees, and then financing fees. So if if a fund has a leverage, it has a financing fees. If it has certain level of assets that it's renting, it will have management fees. So again, most information is shown on the PPM, but it's very critical that you actually understand the cost. What would be like other costs?
Well, anything from, golly, there's a pretty long list here, but the other costs could be insurance in the background, utility fees, other HOA fees. There's the list is endless. And again, anything that you deal with as an individual on your house or something like that is things that have to be dealt with by a fund in the background somewhere. Just because your fund doesn't mean you magically are, not subject to these things, right? So everything that we experience as individuals in the world, as far as fees and extra things, those things, same things apply in the background somewhere. So understanding where all those fit in and how they're allocated for is definitely important.
So this is our last slide. We just wanted to make sure that we covered these type of questions. And again, as you're going through an investment, as you're looking at an investment fund or a syndication, some of the things to go ask, and hopefully you're aware of not only just asking, but what kind of responses to go look for, making sure that you're every investor is different and every fund is different. And the whole magic formula is matching up the right investors to the right fund. Just because a fund thinks it doesn't work doesn't mean it's not the right for certain investors. So obviously, we don't want to dictate to somebody that there's a right or a wrong. We just want to say, here's the things that are out there, and these are the questions you should go ask. So I think we're got one more slide and I think we're done. So this is just our information. If you need to get a hold of us, have any questions, feel free to reach out, and now we can take some questions.
Great. Thanks, guys, for the presentation. Like John said, please use the chat and Q&A function now. If you have any questions for John or Doug, please post them now while we have them available. I'll get us started. John, when you're doing these syndications, is there anything specifically different that one should look out for when they're using a self-directed IRA as opposed to the personal funds?
Yeah, so the self-directed IRAs require a recourse loan. So if a fund is using a self-directed IRA, then if they're taking a lending on it, they have to have a non-recourse loan with it. So it's a little limited. It's that marketplace is a little bit different, and I think Doug can probably talk a little bit more about that.
Great.
Yeah, and one of the things that it's kind of struck my, oh wait, we just got a question in. Let's do that.
Okay, what would you, we have a question from Jeff. What would you say is a reasonable debt load, 80% or less? Any rule of thumb?
So our model obviously is zero debt, because we believe even at a 10% debt, again, the risk of not being predictive of what debt does, right? So if you're in a position and you're only 10% of the debt, if you're not able to make that lending institution some fees or the mortgage or lending requirement at that point, you are at a risk. It doesn't matter that it's a $500,000 property and you only take it only a small amount. The point in time where you're not able to make that return because your cash flow is tight would put the whole asset at risk. So again, this is just a conservative mode from us, but we stay away from that mode.
Yeah.
I can't say what's a safe mode, what's a safe debt percentage.
Right. We think in terms of all or nothing. If you, any kind of debt load could put your assets at risk if things aren't handled properly. And it doesn't mean that maybe the fund handled things right, but the bank, the financial institutions they're working with had an issue. It's a lot like driving. You got to be safe. You got to be the defensive driver, but you also rely on the drivers around you to be safe, and so that you get where you're going. Same thing here. The less we have involvement with someone else, the more control we have ourselves.
Great. Thank you. Any more questions from anybody participating in the webinar today? Any questions that you usually get that you may not have had time to address in the presentation?
So sometimes a lot of people just ask us, how do we find our properties? How do we do our investments and, find these great deals? Usually it's basically our history, right? It's what we have worked through. We have companies giving us off-market properties that they won't list it on MLS. They'll bring it to us directly. So those are some of the assets that we have. The other things are we're related with EXP, right? So EXP is our realty that we partnered up with. They have like 90,000 agents, which means whenever we're doing an investment in a certain area, we have somebody to go call and work with and, make sure that works correctly.
Great. Thanks for that. Another question. Can you explain the preferential rate again?
Sure. So at the end of the day, preferential rate means that that's the rate that the fund has to perform to. So if the fund says it performed to 8%, it has to, at the end of distribution, at the point of it, it has to generate that amount before the fund or the company can take any proceeds over that 8%. So if it performed only to 5%, then that company has to allocate that 5% directly back to the investor, and they can't take any profits or proceeds and anything on top of that.
Perfect. Thank you for that. Is there anything that you and your team are currently working on at the moment that you want to talk about briefly, because it looks like we're getting close to the 1 o'clock cutoff?
Yeah, so what we're really excited about now is our new 506c fund that we started. We are working with accredited investors. Our minimum investment is $250K for that particular fund. But if you go to our website, we have all of our information of non-accredited investors and other projects that we're working on. So it shows the lending opportunities, it shows the other things. So if someone is interested to say, hey, we don't want to, we're not at the accredited investor role, we don't want to go down that path, but we still want to work through some of that. Our website has the deal-to-deal projects that we work on that we can always partner up with people on.
Great. Amazing. Thank you. Thank you again, John and Doug. And if anybody has any questions that they weren't able to get into the chat today, if anybody's watching this in the future, this recording, and have any questions for John and Doug, please use the contact information on the screen. I want to thank everybody for attending and lending their time today. One more thank you to you, John and Doug, and I hope you all have a great rest of your day.
Thank you all.
Good. Thank you all.